Hello, everybody, and welcome to the monthly market memo for the month of August 2025. I'm Case Eichenberger, the Chief Investment Officer with Retire Path Advisors. And in today's short video, we wanted to walk through some of the key catalysts that was moving the market higher, actually, for the month of August, and answer some of the more frequently asked questions from investors like you that came across our desk for the month. So, with that, without further ado, let's go ahead and get into it. Um, the month of August was another good one, building on the month of May, June, July. So we've had several months in a row here of higher stock market returns, and that was led by United States small cap companies. But I'm going to show you here some of the major asset classes we track for the month. The S&P 500, just to start, was up over 2% for the month of August. International stocks, investing overseas companies, was actually higher for the month than the S&P, up about 3.5%. Intermediate bonds, taxable bonds, if you will, were up over one. Cash was up, just positive, of course, it is just cash. And then finally, United States small cap companies were up over 7% for the month of August alone. So, a couple things to point out here, just real quick before moving on, is every major asset class we track beat cash for the month. So staying invested obviously was a benefit to you. And then some other key areas outside of our biggest companies here in the United States added value, like international stocks and small cap stocks. So what I'm circling here next is really that a couple weeks ago on Friday, you saw just a big jump in the stock market for small caps, international, S&P 500, even bonds were higher. And that was based on big news around the Jackson Hole meeting, where our Federal Reserve Chairman Jerome Powell was speaking and really rallied the market. So I want to get into that meeting a little bit because it is somewhat unique and interesting if you look back at the history of it. But the Jackson Hole meeting is something that Kansas City Federal Reserve puts on once a year. They always go up to Jackson Hole, Wyoming, and it kind of falls between two of our major Fed meetings. The Fed meets once a month or every other month, if you will. And this Jackson Hole meeting always kind of comes between a lull between Fed meetings. We have one coming up in a couple weeks, and we had one back in July, but really August was kind of sparse for meetings, if you will. So Jackson Hole really fills that void, and what we saw was an expectation of the Federal Reserve to focus more on the labor market, focus more on the risks around the labor market, and cut interest rates here on the short end. So what I want to show you here in the next couple slides is just why that is so and how that affects stocks, of course. But right now, to set the scene, we're still at over 4% or so on the federal funds rate, the rate you get at your bank for a CD, the rate that it costs to lend overnight, if you will. So we're still pretty high, actually, historically speaking, where at least where we are used to seeing the Fed funds rate post the financial crisis. And right now, if we look at the market making odds, we're at about a 90% chance of a September rate cut, which will come here in a couple weeks. So we're still going to get some big reports before then. Of course, the jobs report comes out Friday, which is important. That was a key thing that moved markets last time. And then the inflation report will come out the next week as well. So a couple key things could move these odds a little more or a little less. But for now, the market is expecting a rate cut, and that has caused stocks to move higher. So let's talk about some of those reasons on why that would be. But first, I wanted to get into really the employment part of the Fed's dual mandate. They have really two things they try to keep in check: full employment, maximum employment, if you will, and stable prices, meaning inflation. Um, right now, we're going to focus on the employment part because inflation, while it's been moving a little bit higher year over year, it's a lot less than what it was. And people losing their jobs does seem to be much more of a focus right now going on with this current administration and with the Federal Reserve itself. So if we just look back at a couple charts here, real quick, I wanted to show you the Federal Reserve puts out and publishes where they think the unemployment rate will end the year. And really, back in July, they came out and said they expected most of it to be between 4 and 4.5, maybe a little higher, 4.7. So if you can see that between the dotted, kind of the blue bars and the red bars, the red thick bars, that actually moved higher since the last time they met. So they were expecting unemployment to move higher, but yet the risks around unemployment and the uncertainty around unemployment came down. Now, one thing to keep in mind is this was before the latest jobs report came in with a big miss. And obviously, this was before the Jackson Hole meeting where Federal Reserve Chair Jay Powell came out and said the focus is the labor market, and we are sufficiently restrictive with the federal funds rate. So all this talks about is really just what leads next with interest rates. And I think this is very important for all of us listening to this video. The focus is the labor market going forward. If inflation rises, it may be more of a transitory thing due to one-time price increases with tariffs, but the unemployment picture is much more important right now. Since that last meeting the Federal Reserve met, we did see a lot change in the jobs outlook. So right now, we just wanted to show where we've been over the last few years of jobs created. As you can see, reading left to right, 2021, a lot of jobs created. We've been coming materially down as far as month over month jobs created. Still very good thing, of course, but it is slowing. And if we look at just a moving average of those month over month changes in the jobs report, it's been getting less and less and less. And that's something the Federal Reserve wants. We don't want such a hot labor market that could spur more inflation. We do want more of a cooling labor market. I'm just going to circle these last 3 months here. This is what happened with some big revisions and probably hit the news if you paid attention, where the Federal Reserve, um, actually, sorry, the Bureau of Labor Statistics revised the last couple months and said there really wasn't that many jobs created. So we're gonna have to see where this ends up this week when I update again. But so far, the jobs market is definitely cooling and surprising to the low end, which is something that we do not really want, which means the unemployment rate may move higher. So if Jay Powell comes out and says we're sufficiently restrictive, which I do agree with, how do we really look at that? How do we prove that? We can look at that a couple different ways. We can look at where the federal funds rate is. Again, it's over 4% right now. And we can subtract that, take that minus inflation, take that minus inflation expectations, and just kind of see where we line up over time. The average over time is about 1%, where Fed funds rate minus inflation is about 1% or so, going back to 1954. If I look at this a couple different ways, and just to illustrate it for you, we can look at the federal funds rate minus inflation expectations right now for 5 years from now, which is about 2. So that's above 1. There's the average line. And then if we look at the federal funds rate minus the current inflation rate that we get year over year, we're about 1.6, 1.5. So again, over that 1% line. And the Fed knows they're restrictive. We know they're restrictive. And if the focus does come back on the employment picture, that is something where they want to reduce the federal funds rate. We can look at this a different way. We can look at this regarding the 2-year yield, which is, if you look at just the Treasury curve, you have short-term rates, the 2-year yield, and maybe the 10-year, right? When bonds mature in 2 and 10 years. But let's look at the 2-year yield. And typically what I notice is when this line I'm pointing out is above 0, we get an expectation of the Fed funds rate to be lowered. If it's below 0, that means the Fed fund rate will actually be predictive to go higher. As you can see, that happened obviously in 2022 when inflation, was a problem. Right now, it spiked towards the end of last year when the Fed was actually getting ready to cut, and that's what they did, right? So we are still much more restrictive than I think what a lot of people realize here, looking at just market expectations on the 2-year yield as well. So all this just comes to say the federal funds rate is restrictive. It is in restrictive territory. Is it too restrictive? I think that's what the jobs market is telling us. If it does continue to slow, unemployment does pick up, then the Federal Reserve is looking to cut rates. And that's what they've really signaled here at Jackson Hole to happen here in a couple weeks in September. So we'll have to see. But so far, the markets did cheer that. And the one thing I lastly wanted to point out regarding interest rate cuts is how much the market's really expecting. So right now, we started the year, the market expected about 2 interest rate cuts by the end of this year. I'm going to paint that line right now. You saw that really spike to around 4 interest rate cuts expected when Liberation Day happened. Of course, a lot of those tariffs got walked back, deals were done, exemptions were done, and now we really finished closer to where we started the year, actually, at about 2. So The expectation from the market is 2 to 3 cuts. I'm probably more on the 2 cut camp, but we'll have to see where the data comes out. And if that cut does happen, that'll take us below 4 if we get 2 cuts by the end of the year. So we'll have to see. And I'll update you, of course, every month on how this progresses. Now, if we do cut in September, this will really just continue where the rest of the world is. So far in 2025, we are in the fastest interest rate cutting cycle for the rest of the world since 2020. Now, 2020 was COVID. That was a different thing, right? As a global recession, pandemic, we needed to cut rates everywhere. Right now, it's really more on the fact that inflation has come back in control, more in control, if you will. It's not completely in control, of course, but we're getting there here in the United States and here in the globe. So this really just shows that blue line that a lot of countries outside the United States are cutting, and we're set to join that as well if we cut in September, which I believe we will. Now, the obvious question here to kind of end this call is where does this lead the stock market? I think that's the number one question we got is if we cut in September, what happens to the stock market? Is that a bad thing? Where do stocks go from here when we cut last year, waited a few months, 6 months or so, and are cutting again? We can actually look at that data. And also, let's look at data. We're actually cutting near all-time highs in the stock market, which seems kind of odd. Normally, you get a lot of cuts when things are bad, right? But that does happen on occasion. And both times we've seen the market move higher. So here on the left-hand side is looking at the stock market after a big pause like we just saw and cuts resuming. The stock market rallies into that expected cut, which is what we've seen so far, and then continues to rally after that cut occurs with the anticipation of potentially more interest rate cuts. Again, remember, more interest rate cuts are typically stimulative for the economy, helps curb other unemployment metrics, and therefore can be good for stocks. Let's also look at this within all-time highs of the stock market. Does this kind of paint the same picture? And we believe it does. If we look just 3 months later, 6 months later, and a year later, markets are all higher on average. And 1 year from now, on average, up 14%, which is typically better than your average year, right? The percentage of chance getting higher is good as well. A year from now, we've never seen lower markets. Now, you never say never with stock markets, of course, but this is a good batting average that you can kind of hang your hat on right now. So all else equal, to wrap up this call, we wanted to talk about that Jackson Hole meeting. It did cause a big uptick in stocks in August. We'll see where we end September, but for now, the expectation is for a cut and maybe 2 by the end of the year. And that can be good for stocks. As we've seen in past history, it has been very good for stocks. So, of course, we will update you with next month. I do hope you had a good summer, and we do approach the management of your complete landscape, financial landscape, very seriously. As a trusted steward, advocate, and confidant, we're completely committed to you, the client. Please reach out to us with any questions. You can reach out to your financial advisor here at RetirePath, myself, call our local number, email us, find us on the website where we update our thinking there as well. So thanks again for watching, and we hope you have had a good Labor Day and a great upcoming fall season. Thanks again. Bye.